Welcome! We're diving deep into an event that hasn't occurred in over 4 decades, the catastrophic crash in the price of gold. For decades, gold has been the ultimate insurance policy, but that rulebook just got incinerated. Gold has plunged nearly 5%, stunning investors globally. This single-week drop has effectively erased all of gold's gains for 2026. To find a weekly drop this severe, we have to go all the way back to 1983. But here's the terrifying part. Gold isn't falling because peace has broken out. It's falling because of an internal contradiction in the market. Standard theory suggests that war in the Middle East means people buy gold, the fear trade. But in the last 7 days, that trade broke. Why? War-driven inflation fears are actually delaying interest rate cuts, which is the primary driver. When rates stay high, holding dead assets like gold becomes too expensive. The core of this market shift is the price of energy. Everything in the global economy is downstream from oil. We are witnessing an Iran war-driven oil shock that is actively weighing on global growth, affecting the cost of every product shipped and manufactured. This surge in oil costs is directly impacting the Purchasing Managers' Index, or PMI, which is the pulse of the global economy. Declining surveys signal a broad slowdown in business activity, moving us into a, quote, survival mindset. The narrative of the first half of 2026, inflation is under control and the Fed will cut rates soon, is officially dead. Bank of America, Citigroup, and Goldman Sachs have all officially delayed their rate cut expectations. This is a massive U-turn from just weeks ago. The banking giants realized that cutting rates now would be like throwing gasoline on an inflationary fire due to the persistent oil shock. Furthermore, rising inflation in China means secondary waves of, quote, imported inflation for the West. When you combine a 5% crash in gold, a massive oil shock, and the world's largest banks sounding the alarm, the result is clear: global economic contraction. We are seeing a rare and dangerous alignment where growth is slowing down, as seen in the PMI data, while prices are staying high due to oil. This is the stagflation nightmare that economists have feared since the late 70s. The comparison to 1983 is no coincidence. That era was defined by high rates and geopolitical instability. So what does this mean for your money? Here is my expert interpretation of the trends described by the banking sources. If gold can plunge 5% during an active war, the old rules of diversification are broken. Investors are moving toward cash and liquidity because they expect interest rates to stay high for much longer. Watch the PMI closely. The data suggests a broad slowdown in growth is already baked into the cake. And with banks raising China inflation forecasts, expect the, quote, cheap goods era to face another major hurdle. We are in a period of extreme volatility where war-driven inflation is overriding every other market signal. The 2026 gains for gold are gone, and the question is, are the stock and housing markets next? I want to hear from you in the comments. Do you think Goldman Sachs and Bank of America are right to delay rate cuts? Or are they being too cautious? Are you still holding gold as a long-term hedge? Or has this 5% drop changed your mind? This situation is moving fast. If you want to stay updated on the global PMI surveys and the next move from the big banks, make sure you hit that subscribe button and turn on the bell icon. Stay informed, stay rational, and I'll see you in the next video.